For today's podcast, we have a guest who is a mortgage broker with a vast industry experience. We love your support at Property Dollar, and we would request you to subscribe our channel so we know if you're liking our product or not, if you're liking our content or not. Before we jump into this podcast, we would like to tell you that the information provided in this podcast is in general in nature. Before taking any decision regarding your home loan or your mortgage, please consult a professional, a financial planner, or someone you're already consulting, right? So please take all this advice in this podcast as a general information only. Enjoy the podcast. Good morning, good afternoon. Welcome to the third episode of Property Dollar podcast. And today with me, I've got Andrew from Flint, who is a mortgage broker. Andrew, how are you? Thank you for joining us.
Thanks, Real, for having me. I'm looking forward to it.
Awesome, man. Why don't you tell a little bit about yourself?
Thank you. I've been working in financial markets for over 25 years.
Oh, wow.
And in wholesale interest rate markets, trading in derivatives. The last few years I've been in the mortgage space, helping people find a home loan.
Awesome. So you know a little bit about money.
It's certainly about money and interest rates.
And interest rates. Well, I can tell you a lot of my audiences would be very interested in your thoughts about interest rates, but we'll come to that later. Mortgage broker. What is a mortgage broker?
Mortgage broker is someone that assists people or investors to get a home loan. It's a minefield out there. There's obviously many banks, but the amount of products that they offer, it's quite traumatic going through that process, working out what's best for you. So a mortgage broker basically guides you through that process to get a home loan.
Right. So in a sense, there are a lot of products offered by the banks when it comes to buying your residential property or investment property. And sometimes it can be very daunting and confusing to pick which product is right for you or for your situation. And that's where the mortgage brokers comes and gets you the best deal.
Exactly. So, your bank where you do your banking every day, obviously would offer a home loan service, but everyone's situation is unique. And the bank that you bank at regularly may not have a product that suits your situation, or it may be that you can't service a loan at that bank. So what we would do is get all the information from you, your financial information and all those facts, and go through the process of assessing your capacity to borrow, and then we weigh that up against over 40 lenders and all the products, and depending whether we're going to look at variable rates, fixed rates, all those things, and we would come back to you with likely the best three options.
Right, that's awesome. That actually explains me one of the questions that I was going to ask you, that why go with mortgage broker and not go with bank directly? But then I think you kind of that answer is that, look, I'm going to look at 40 banks. You're going to look at 4.
So we obviously have systems in place that makes that process more efficient. But it is literally the task of working out what's best for you, and who has the time. We literally do all the hard work for you, all the legwork, to work out what's best for you. And the good thing about that is the service is free.
Awesome.
So we don't get paid by yourself. We get a commission from the bank once we've settled the loan.
So Andrew, I'm going to ask, I've got so many questions written on the piece of paper. I'm going to go through this, but I'm going to ask you this question, and I'm going to repeat this question again at the end of the podcast, right? What is a good mortgage broker?
A good mortgage broker is someone that works in your best interest. So they will educate you along the way and what to look for, and provide that information to you, easily so you can understand it. As I said, it is quite daunting, certainly for first home buyers that may not be aware of what that process is. So someone like myself would come in and basically take your hand and hold your hand right through that process to getting a home loan.
Awesome, awesome. You did say something about first home buyers, and I'm personally passionate about first home buyers. I myself was a first home buyer once, and I had to face a lot of difficulties and find information, all the information by myself. Luckily, my mortgage broker happened to be my friend. And at that time, I knew he used to do something with the banks. I thought he was a banker because I wasn't aware of what a mortgage broker is. But then when I told him I'm going to buy this property, and then he helped me out with the mortgage broking and everything. But that's, I think, the level, and I'm talking this few years ago, but I think that's the level of education when it comes to first home buyers. They may not be aware of the definition of key players in the property market, right? So when a first home buyer comes to you, what are the first few things you will ask a first home buyer to do?
Well, the first thing we would do is sit down and work out what their capacity is, what they can afford.
Borrowing capacity?
Borrowing capacity.
Yeah, okay.
What's affordable?
Mm-hmm.
What deposit do they have in place? What avenues to deposit? Whether they can use, the government schemes that are out there that are very supportive for first home buyers. Whether they have money that can come from, mum and dad. The Bank of Mum and Dad's been popular,
Mm-hmm.
with guarantor loans and equity releases in their properties and so forth. So we do an overall plan. We look at a budget for them, and work out what their income is, what their expenses are. Whether they have credit cards or HEX debt. A lot
Mm-hmm.
of young people have, attending uni now,
Yep.
have a HEX debt,
Mm-hmm.
which is indexed every year. So that adds to their, against their capacity to borrow. If they've got any other liabilities like a car loan or a personal loan. So we do a full assessment of what's possible. And then once we can sort of consider what they're looking, so it's always like, what are you looking for?
Mm-hmm.
And then we work backwards and we see how we can achieve that.
Mm-hmm. So defining the target with them, and then working backwards and how we can achieve that. Whatever you said, I have like permutation and combination of questions over there, right there. So you did say something interesting about the car loan, right? And the HEX debt, etc. If you do have a car loan, how does it impact your borrowing capacity, especially if you're a first home buyer?
It affects all borrowers,
All
not just first home buyers,
Mm-hmm.
because when the bank does their calculation, they look at your liabilities. So if you had a car loan, for example, let's call it $20,000,
Mm-hmm.
that affects your capacity by about $80,000.
What?
About
Four times?
It is ridiculous. So these are the things we got to consider when you're looking at what you can afford.
What is the reasoning behind that?
It's the debt to income, and that's what we're looking for. So ideally, when rates were lower, that your debt to income was higher.
Mm-hmm.
As rates have increased, the debt to income has reduced.
Mm-hmm.
So it's now roughly about 4 times.
Mm-hmm.
So if you've got debt of 20,000,
Mm-hmm.
it affects your borrowing by about 80,000.
Wow. And if someone comes to you with their first home buyer request, they want to buy maybe an apartment or a property worth of 600K, 700K, and they have a car loan of 25, 30K. What do you advise them? Do you advise them paying off their car loan right now, or it depends on situation to situation?
As I said before, everybody's situation is unique.
Mm-hmm.
And in that instance, it would then obviously depend on their income.
Mm-hmm.
So as obviously part of the assessment, we look at the income, and their income may be able to, cover that liability.
Mm-hmm.
But if not, then we look at ways we may be able to consolidate that debt into the home loan, because
Mm-hmm.
obviously most car loans are between 5 and 7 years.
Mm-hmm.
If we can consolidate it into the home loan, obviously the debt gets spread over 30 years.
30 years. Yep.
So that's something that we would consider. Obviously, the option to pay it out would help, because if you pay out the loan of 20, then you know that you're going to borrow 80. So
True.
that's an option. So that comes down to how much they have for a deposit,
Mm-hmm.
And they're all the things that we look at.
Mm-hmm. That's very interesting. So, yes, okay. If there is a challenge, if you think that you have a car loan and your borrowing capacity would be like 4 times reduced, Don't worry about it. Just don't Google it. Instead of go to the doctor, instead of go to a mortgage broker, speak to someone who knows the process, and they can advise you with these kind of tactics, I would say.
And these are the benefits of using a broker, because they're familiar with that's what we do every day, familiar with what we need to look at and how we can benefit you the most to achieve the best
And banks
outcome.
wouldn't do that. Banks wouldn't spend that kind of time.
The banks have their own brokers, and they would be looking at things like that too. But as I said before, if you're going directly to a bank, you are limited by what that bank can offer, and it will affect the way they all calculate their capacities differently. So where we could borrow $600,000 at one bank, we may only be able to borrow $500,000 at another bank. So if you walk into that bank for $500,000, you think, well, that's all I can get, when there are many better options out there for you.
Can I ask you? Can you share a story of a first-home buyer, if you remember from top of your head?
Oh, there's been a few. I actually just did a loan for a female client just before Christmas, who had been looking for 12 months for a property. We rolled over a pre-approval 3 times, and then finally she found a property before Christmas. And they're the things that I guess give you satisfaction in what you do. That one was a relatively straightforward one. She didn't have to rely. She had a good income. Didn't have to rely on the benefits, government benefits, and so forth. But just seeing the thrill that she got from doing that's what makes it happy. And then there are others where that they've got a minimal deposit, 5%, which is the minimum for a first home guarantee. I work with a couple who had minimal income, minimal deposit, but utilising the government scheme, we were able to secure a unit in Kensington in Sydney for $700,000.
That's nice.
Again, they looked for about 6 or 9 months, and they were over the moon when we got that deal done.
That's beautiful. And one thing is so very interesting about this. So a lot of first home buyers, sometimes they're confused or they don't have the right information, and they think that they need to have 10% deposit or 20% deposit. Can you burst that myth for me, or what is the reality behind that?
That is the myth. As I just touched on there's a national scheme now by the federal government, First Home Buyer Guarantee, where a minimum deposit is 5%.
And how do you qualify for that?
So there is eligibility criteria around that. For singles, they've got to be earning up to $125,000. As a couple, I think it's $200,000 the threshold. So there is certain criteria. You've got to be an Australian citizen. They recently expanded that criteria to include permanent residents. So they are now eligible under that scheme. And I think the property you can buy up to $900,000 in Sydney metropolitan area. So for a $900,000 property, they need a $45,000 deposit. There's other state government schemes in New South Wales.
Stamp duty is exempted.
Stamp duty between $600,000 and $800,000. There's a full exemption. Above $800,000 to $1 million, there's concessions. So someone buying at the top of that range at $900,000, again there will be a deduction in their stamp duty. So you can get into a property for $900,000 with about $60,000 in savings.
Okay, that's an eye-opening thing for me. Besides that, like even with all these facts, we still see first-home buyers are struggling, right? Government is doing so much. There's so much information out there. There's systems in place to boost first-home buyers to get on the property journey. What are we not doing right?
I think the hardest thing for first home buyers is the appreciation we've had in capital values of properties. We can see back in 21, I think it was, that we had nearly 30% increase in values. They did retreat in 22, have seen sort of a slow start to 23, but we're now starting to see the properties increase again. And I know I've got a few people on my books, that can sort of get up around 1.1, 1.2. Are struggling to buy in Sydney. So those buyers have to reassess, and okay, so I can't live in a coastal suburb. Maybe I might have to move out further, or you might have to move up the Central Coast maybe, or look at other areas, and that's where property advocates and advisors can assist with that process. Buyers agents,
Buyers
and so
agents,
forth.
And I have seen, not that this question does concern you, but I've seen hence the reason why I see buyer's agent, I would say, recommending properties which are outside Sydney metropolitan, which is outside Melbourne metropolitan, because I think their audience is someone who is not able to afford in Sydney or is not able to afford in Melbourne metropolitan. Is that the right thing to say?
I would agree with that, and I think for first home buyers, they're looking at affordability and limited budget. Then that's the areas they have to look at. As an investor, we've seen big booms in Brisbane and Perth and Adelaide and outside in regional areas, but that might not necessarily suit a first home buyer, with their work situation or so forth.
Absolutely. Now, speaking of metropolitan, what are your thoughts? What's happening with Sydney property market?
Well, as I just touched on, we saw a massive increase in prices back in 21. With I guess there was a lot of stimulation from the government during COVID. We saw a retreat in 22, but not all the way back. I think it certainly looks a bit stronger at the moment. I think the outlook, certainly the major banks, if you look at their research, somewhere between sort of 4 and 6% we're looking at across the major cities in the next 12 months, and somewhere similar in 25. So it looks like we're going to see steady increases now around sort of 5%, I guess, over the next couple of years. Obviously, we're expecting some interest rate cuts. I personally think that probably likely to see that in the latter part of this year.
Yep.
The good news is that we're not likely to have any more increases, so that's good. That obviously will help borrowing capacity. We've obviously got some tax cuts coming in July this year, which again, I think you assist your borrowing capacity by about another 5%. I was looking at some numbers this week. On $1 million loan, a 25-point reduction in rates is about 50K in capacity.
Oh, okay.
And a 5% reduction in our taxes this year. We'll see another 5%, which is another 50K. So we will see capacity start to increase, which again will put pressure on prices.
Which again, price increase again, difficult for first-time buyers.
Look, when demand is outweighing supply, you're going to see rates increase, and that's been one of the issues over the last couple of years, is we just have not had the supply of new buildings.
And do you think that's the main reason for
it's
price rise,
one
demand
of them.
versus supply?
Well, it's demand, and then that's caused by many reasons. We've had migration. I think from 22, I was reading somewhere, until the end of 24, we're looking like 700,000 new people in the country. So that again, that pushes demand. Obviously increased borrowing capacity. We've had high interest rates now for the last couple of years, comparative to where they were. So as people have more capacity, then there'll be more prices. There's obviously government incentives to assist first home buyers, so that puts pressure on it. At those target levels around 900,000, for example, there's more people at that sort of range. So there's many things that put pressure on the prices.
Do you think Sydney property market will transform to something like Hong Kong, where it's completely unaffordable?
I hope not. We obviously would like to see some increases in real wages to assist that, but it is. I don't think. I hope we can't see prices like we see in Hong Kong.
I hope not, man. To be honest, let's move into investors, and I'm sure this, whatever you have shared with us, it's going to be so helpful for the first-time buyers. But let's move to investors. What is the split in a specific month? What's the distribution of customers you see, investors versus first-time buyers?
Investors against first home buyers, there would be more investors each month. Owner occupiers to investors is, it's more like sort of 70-30, I guess.
What's the sentiment like for investors right now in Sydney?
Well, they're still purchasing, right? So, and again, as an investor, you're looking at things like location. So Sydney and the major cities are a good area to buy. They're historically proven that capital growth has been there. So you've got to think about your cash flow every month to cover your loans and so forth and costs, but you're only going to make money when you have capital growth. So as an investor, these are the things and the areas you look at, and that's where I guess the research is so important. For a first home buyer, it might be, it is an emotional transaction to buy your first house, but as an investor, and really a first home buyer should be the same. They need to be able to do their research and work out, what's best for them, what's going to be the best return on their investment.
So what's their flavor right now for investors? Is it they're banging on about Sydney Metropolitan right now, or Melbourne?
Well, in the last 12 months, the growth areas have been Perth, Brisbane, and Adelaide. And you look at the vacancy rates for properties. I saw something during the week. It's sub 1%. That means there's 10 vacant houses in every 1,000. That's not a lot. That's basically that's full capacity. So as an investor, you've got to look where you can add value. You obviously want to want the best rental return, but if you're looking to see whether you can make modifications or minor renovations to a property to add value to it, but they're the sort of things that you're looking at. Obviously, where those properties are, whether they're in areas with good infrastructure, whether you're close to schools, hospitals, transport routes. These are the things that they're looking for.
I heard from one of this podcast, and not Australia specific. So this guy's from the States, and he said very interesting thing, right? So he said, and been involved in property investment for past 30 years. So he has a couple of $100 million worth of property portfolio, and he said very interesting thing. I don't know if this does qualify for Australia or not. He said you can invest in two type of properties. One which is going to give you cash flow. Usually the properties that will give you a positive cash flow are going to give you less of wealth or capital gain. There's another type of property which is going to give you very less cash flow, but in future long run they're going to give you a lot of capital gain. So he says invest in more of this and less of this, but have a combination of both. What do you reckon?
I think he's got it right, and I think the fact that he's got a couple of $100 million in assets would suggest he's doing it right. The cash flow is the oxygen. It keeps your costs, covering your costs and so forth. But like I just said before, to make real wealth, the property needs to be appreciated in capital value.
True.
So although you need a good return with your rents and so forth, and looking at how you can reduce your expenses, that keeps you going, makes you able to purchase the next property, but you're putting deposits away and so forth. But where you make your real wealth is through that capital.
To that capital
right. Appreciation.
So investors always look for capital, and then cash flow is important, but capital supersedes everything.
And we're in a good environment at the moment, as I just stated, with vacancy rates as low as they are. The landlord has had more power to negotiate a better rent, and that allows you to keep your expenses in check. But wealth is built through the appreciation in capital.
Absolutely. Now let's go a little bit down into the basics, right? I'm a owner occupier, okay, and I am going to buy my first investment property. What are my ABCs for getting a good mortgage deal? What should I keep in consideration? First 5-6 steps.
From the mortgage perspective, what we'd obviously look at is what deposit you have. Obviously, we'd assess your income and work out what your borrowing capacity is. But depending on the deposit, we'd also look at what equity you have in your current property. So you may not have any cash for a deposit, but you've got plenty of equity in your home. So we would look to raise your deposit and cover your costs through equity, raising the equity in your home. And then, general assessment, we look at what's affordable. And again, you'd seek some advice on areas that you'd want to invest in, so that you're going to be covering the cost of or close enough. Obviously, we have negative gearing there too, which assists investors. But they're the sort of steps that we'd look at is what your affordability is, where we can raise the equity or not, whether you have a deposit or not. and then obviously that we look at what rental return you'd get on the property that you were looking at.
And what are your thoughts on negative gearing, just sort of a segue?
Well, it's one of those things, isn't it? It certainly assists people where the if your expenses are outweighing your income, then you're able to offset those losses against your taxable income. But I guess if your property was positively geared, then that's a pretty good situation too. So I guess negative gearing, it certainly is a good fallback for investors when their expenses are higher than their income. But I guess if I think there's 3 phases to the process. You accumulate, you consolidate, where you're paying off those debts that you've accumulated, and then the last one's lifestyle, where you can live from those investments. So in a perfect world, positively geared property, yes, you're going to be paying some tax, but that's a good thing because that means you're making money.
And regardless of that, why do still people go for negatively geared properties?
I don't know that.
Or is there a type of people?
I don't think that they actively look for a negative geared property. Obviously, you'd be doing your research and working out, what rental return you're going to be, and there obviously there are costs that come up that you're unaware of in any given year, I guess, and that's where I guess the benefits of negative gearing help. But you should be able to have a look at an investment and ideally you think, well, that's going to be a good one. I'm going to make money. If there's unforeseen things that come up during the year, then you have the benefit to offset against your income.
Interesting. And then coming back to getting an owner-occupier to become an investor, you did explain a little bit about the mortgage. Apart from that, from your own experience, what are the things outside the mortgage that they should be aware of?
As an investor, or
as an owner occupying buying their first investment property?
I think aside from the mortgage, obviously we got to determine what your affordability is and your capacity. But it's like anything, you've got to do your research, and if you're looking to buy a property, I said before, it's easy to be an emotional transaction. You want to look at the location, you want to look at what's around, you want to look at historical trends in an area. There may be that in this last couple of years a suburb hasn't appreciated as much as another nearby. Why is that? And then you might think, well, that's a good opportunity. So they're the things I would look at as an investor. You're always looking to maximise your return. So as much research as you can do on areas, suburbs, trends, that's where I think you'd look.
And the research would include what, like population demographics, growth, government spending?
Yeah, infrastructure, the demographics of the area, rental yields. They're the things that you'd want to be looking at for an investment point of view. Whether it's an area where owner-occupiers would want to live, because if that's where they want to live, then that's going to push prices up as well. But yeah.
So this is again a question. So I actually, when I'm for my research for Property Dollar, I actually go through a lot of Facebook groups and I see their discussions, right? And there's one discussion that is coming up again and again. I see a lot of good mortgage brokers providing their feedback in the comment section. And the question is, hey, I'm getting this loan and the interest rate, the loan is getting approved. They're giving me the right value for the property that I want to buy, but the interest rate is too high. Should I go for it or not? And most of the mortgage brokers, their advice is, look, you can still shop around, but don't look at interest rate as a yardstick to go with the mortgage. That's not the only thing you should be looking at. You should be looking at the approval, etc. What are your thoughts on that?
It's a good point, and it comes back to why you'd use a mortgage broker. So when we do an assessment, ideally we look, if you're able to service your debt, no problem. So let's say that's not an issue. We're looking at your maximum borrowing capacity. Now the maximum borrowing capacity at one bank might be, let's call it $1 million, but the rate there is 6.3. And we can have a look at another lender where your maximum borrowing capacity might be 800,000, but the rate's at 615. do you want to pay the lower rate and buy a lesser property, or do you want to pay the higher rate and buy a better property?
Buy a better property.
And that's what it's easy to get sucked into the rate being the lowest. It's not always the case. It's a lot of the time we'd look at it and go, this is your maximum capacity and the rate's here. But these are the discussions you have with your broker. We work out what you can afford, and it not necessarily will come down to rate.
And you say things like 6.15% to 6.3%. I remember the first time I bought my property, I was juggling around, should I get it for 2.25% or should I get it from 2.5%? Gone are the days.
And you weren't sure back then. And I talk to clients every day about in the process now coming off fixed rates. And I get excited when I ask the question, oh, what's your fixed rate? And, oh, is it 195? It's like, wow. I'm sorry to give you the bad news, but it's going to have a 6 in front of it at the moment. So,
will we see those days again? What do you think?
I don't think so. I think I think the RBA admitted that they overshot it on the way down, but they had to be protective, I guess. I'd like to think we could get there, but I don't think that's possible.
What do you think it will land to within a couple of years?
The majors have sort of got some forecasts out at the moment. Sort of, I think CBA is the only one below 3%. They're thinking by sort of mid to late 25 they'll be at 285. I think expectations around sort of 3.25, 3.5 are probably more realistic.
You reckon we can reach there again?
I think so. I think we're going to see a longer pause. There was talk that we may have even reduced rates in the first quarter this year, not that long ago. That's now looking more like third quarter, latter part of this year. But that will depend on a lot of things. So obviously we got inflation still, I think, above 4%. They want that band in 2 to 3. So inflation's still key. I think we got some numbers out in the middle of April, so that they are important. I did notice that we had some reductions in the inflation sort of come down quite a bit in the States, but last month was up slightly. Unemployment will be a driver, I'd imagine. And yeah, I think around that sort of 3.25, 3.5 is probably realistic, which is still historically very good number. Very good number
compared to what we are here today, right?
Definitely.
Again, coming from few comments on the Facebook group. There are a lot of experts on Facebook groups. But for me, I do my market research, so I get that, so that it's free information for me. I'm going to ask you a couple of difficult questions. Difficult in nature, not because of the knowledge that you have to share, but because of the opinion you need to have, right? So it's been frowned upon if you buy something which is off the plan, number one. Number two, I've seen a lot of people, should I use the word demonize, or should I questioning their intelligence if they're buying apartments? You did say something about first-home buyer buying an apartment in Kensington. What are your thoughts on that, considering the Sydney and Australian property market going in a way where Sydney is a metropolitan, right? How do you think the high density will play a role in our property market, and how do banks react to it?
Well, there's a few parts to the question. Obviously, historically, if you've bought a house, it's appreciated more than if you're buying an apartment. But when affordability is an issue, then obviously, if I can't afford a house, I look at an apartment. And if you're looking at an apartment, I can't afford it in this area, so I look at another area. So there's those things. As far as off the plan goes, they come with their own risks. And again, it's a risk reward. But in the last few years, we've seen massive increases in the cost to build, labour, the raw materials. So those people that locked into a contract a couple of years ago, let's hope that they
get at the same price.
Well, if everything goes according to plan, that they settle on that property a couple of years later, they're likely to make a reasonable return. But we've also seen in the last couple of years a huge amount of builders go out of business and people left with unfinished houses, which is an issue. You touched on high density or high rise apartments. Banks have criteria in place, depending on the height of the building or the number of apartments in a building. So there are eligibility around that.
Oh, okay.
So most banks will lend to 80%, but depending on, there might be certain postcodes or restrictions due to the size or height of a building, they may only go to 70%, for example.
And is that a risk thing for the bank?
That's how they measure it. So that they deem that would be a higher risk than something in a low rise or less density area, I guess.
That's interesting. You know why? Because when I hear Chris Mintz, he wants to go for high density apartments or high density housing near all the public amenities in the west area line. But on the other hand, banks are treating the mortgage on those as obviously, as you said, a little bit risky sometimes. Do you think there needs to be an alignment between the banking industry and the government?
Yeah, they're independent, I believe, but they're always looking at these things, and banks are always moving their eligibility criteria and so forth. But that was just it's not common. I remember the Gold Coast years ago because of all the high rise. A bank wouldn't want to have mortgages over every apartment in the building. So it might be that there's certain addresses, for example, where they have a register to say, look, we'll only go to 70% on this one from here. So they're the things that they look at. But certainly, government, when they make these announcements and as you said, these corridors that they're building and going to extend up the heights of buildings and so forth, then the banks will have to come in and have a look at that and see how that affects their.
Otherwise, they're going to lose on such a big market, anyways, right? Let's move towards mortgage broker. I want to know mortgage broker as a person, right? And I think it's a good opportunity for homeowners, investors, and first-home buyers to understand how easy or difficult this job is. Being a mortgage broker. How is being a mortgage broker?
Oh, I really enjoy it. I obviously had a background in financial markets, so I'm comfortable with rates. I love the numbers, and always had a bit of an interest in real estate and having bought and sold. I've built duplexes. I've done major renovations, so I sort of cover a wide range of things in the real estate space. So sitting down and as I said, everyone's unique. Their situation is different. Everyone that sits down in front of me, they're all different. So being able to work through, show them what's possible, and a lot of the time they don't understand. So that's why they're coming to you. So being able to inform that person what they need to do, what they can achieve, that's exciting. And when I talk about first home buyers, particularly, that's been an exciting space. But one of the areas I'm moving into with Flint is to help the older generation. So people that are looking to downsize. Now, whether that's to help their kids, but there's a lot of older people now with properties that are unencumbered or have a huge amount of equity who maybe recently retired and think, I don't have any cash, but I have this asset. So I'm now looking to assist those people to, provide options to release equity to enjoy a long life.
Well, nothing wrong with that.
No, it's a good thing.
It's amazing. You don't have to maintain a big house. You can go into these 5-star looking, apartments or townhouses. You'll be fully taken care of. It's just beautiful,
And I think with that too, people don't realise I'm not working anymore. I can't afford it. I don't have an income. That's not the case. So those are the people now that I'm looking to assist with options, and through that, then they can help their kids as well.
But the thing is that these folks did make a right decision when they were young, right? And bought a house.
they bought a house at much better rates than they can now,
I'm sure
and paid off a mortgage at probably higher rates too.
Yeah.
But
I'm sure at that time
They
they'll be going like, yeah, 60K is too expensive.
they can now enjoy the fruits of that, and that's something I'm excited about. Is helping those people now realise that there are other options out there. They're not, stuck in there maintaining their big house or all that. So that's exciting too.
What's the most disheartening thing about being a mortgage broker? The most difficult thing, if you have to.
I wouldn't say it's difficult. I think it's managing expectations. I guess with rates increasing, quite rapidly over the last couple of years, it has reduced the borrowing capacity. I'm not sure if I touched on it earlier. A loan, we'll call it 500,000 back at the start of 22 when rates started to increase. That same capacity is almost 50% less now. So the person that could borrow 500,000 back in 2022 can borrow just under 300,000 now.
Wow, that's not good news.
So managing those expectations. I guess on the other side of that, we've had all these people that were fortunate, and I cheer them every time I speak to them. I say, well done, you've done a great job, that are coming off those low rates and now have to service at a higher level. And sometimes that's not possible, so they are stuck at the bank that they're at, and they're, that's what we call mortgage prison, and they are, stuck with the rate that they have to pay at that bank. So they're the options, maybe they're better options elsewhere, but they can't service.
So if you're buying an investment property, does showing future income from the rent help you increase your borrowing capacity?
Certainly. So when we do an assessment, the rental is obviously is part of that. So you'll show your income and from rent, and obviously take into account your expenses, and that's how we arrive at your borrowing capacity. Another thing, when you've got a home where you're paying your home loan off, principal and interest, what we'd advise an investor to do with buying an investment property was to pay interest only. So that'll increase his borrowing capacity as well. But what it does do is obviously the interest on his investment loan is deductible. At the same time, it allows him, if he's got excess funds, to pay down his home loan quicker, which is not deductible.
What about credit cards?
Again, that's part of the assessment. So, you have people come to you and say, I've got a $50,000 credit limit. Said, I'm sorry, sir, but that's going to affect your capacity by a couple of $100,000. So
really,
then
just like car loan,
that's it. It's debt to income. So that's one of your liabilities. So obviously, when we're doing an assessment, we say, well, can you get away if we make this 10,000? Or in some instances, if they're steadfast on wanting to buy a property and they need the maximum amount, then we get them to close the credit card. But they're the things you can look at.
Interesting. One thing I wanted to ask more from a customer point of view, and this is coming to the wrap up of our podcast. But remember, I asked you what's a good mortgage broker. Now I'm going to ask you what's a bad mortgage broker. Now, the reason why I ask and the context behind is that when we were listening to the crowd, one question came up is that once the mortgage broker gets their commission, the communication sort of goes down way. Right? So if there are any questions that I want to answer to before getting the commission, the response time was 5 hours, and now it's like 48 hours. Is there any truth to that? Are there people like that? Like, yeah, I've got my commission, I gotta go.
I would hope not. As a broker, that we're paid a trailing commission on top of an upfront commission, and that commission is to look after you. So one thing I would say, and I try and promote, is that my phone's on 24/7. So if you want to contact me, there's the number. I have it on my email. Contactable 24/7. I have a link there that you can book in and speak to me anytime. But yeah, communication is a big thing. At Flint, we review your interest rate every 9 months.
Oh wow!
So that process, we'll get a reminder to come back, and we'll do a review of your rate, and then we'd come back to you and say, look, currently your rate you've got is best in market. nothing to do here for the moment.
Mhm.
We have monthly newsletters which go out and keep you up to date with current market insights. Very big on social media and LinkedIn and so forth, where there's articles posted pretty much every other day.
Yep.
Are keeping you abreast of that. So we'd encourage you to join those platforms.
Yep.
And follow us, so you're kept informed all the time.
You can do that because I think Flint is a well-established organization, and you do have tools and resources at your disposal. Then would that be correct to say is that if you're choosing between mortgage broker A and mortgage broker B, rather choose a mortgage broker who comes from an established organization, because they would have resources that will help them help you,
Exactly.
or instead of going with one person mortgage broker.
Exactly. So yeah, having that information at hand all the time makes the whole process for communication easier.
Yep.
And working with obviously a proven team in Christian and Chris have proven to be at the top of their game, and now implementing it across a wider brokerage. That's where you get the support and your knowledge, I guess.
And the contacts to the banks.
Contacts. Again, with those things, your top tier lenders, we have priority with those.
Absolutely.
So those are the benefits of dealing with a bigger organisation.
So to summarize, if you want to pick up a mortgage broker, a good mortgage broker is one who is working in your best interest. So who is looking at what your end goal is and working backwards, who is managing expectations, who is truthful to you, who is in constant communication to you even after your loan is settled, and keeps giving you information that will help you improve your interest rate or loans, and is from an established business, which is trustworthy and have got a priority with the banks.
A proven record.
Proven record.
Yeah. You touched on something there. The broker is always working in your best interest. So, whether it be, what your maximum borrowing capacity might be, whether it's the best rate that we can achieve, when we come back to you with an assessment, those options are always considering your best interest as a borrower.
Andrew, thank you so much.
Royal, thank you. I've enjoyed it.